Metamaterials has attracted a lot of attention in the traders community recently, mostly because of the volatility of the share price as well as the strong fundamentals that the company may be able to deliver in the future. Before we begin the video, I'd just like to state a brief disclaimer. What is presented in this video is going to be my opinion and my interpretations on what the reality is, or how things are and should be. They shouldn't be considered as investment advice and should be watched for entertainment purposes only. They may be able to help you to make more educated decisions, but should never be considered as the sole material for the decision-making procedure. Most of my analysis is done in the immediate past or the past few days before the uploading of the videos. The price action may not reflect the latest ones, but it still can be a useful tool to analyze the current momentum. And in fact, it's even useful to come back to older videos to see whether what I've predicted before became the truth or not. Also, the analysis will try to cover the stock as comprehensively as possible, and it's going to talk about more factors than just the latest news or the price actions. For instance, we're going to talk about the company's financials, the stock market trends, the long-term perspectives, and the shareholder behavior. So these factors are going to affect our timing, the quantity, and the actual decision. Since most of my viewers are first-time viewers, it is important for them that we touch all these factors. So with all that being said, let's begin with today's video on metamaterials. So metamaterials develops high-performance goods for high added value and hopefully at a more affordable cost with better scalability, sustainability, and efficiency. The company's clients include Airbus, Lockheed Martin, and Satair. Also, I would like to argue that a company that is involved at this level of sophisticated technology is unlikely to just let go by the authorities like that, because this may involve secret defense or similar stuff. It's the same reason why the 3 American manufacturers are not easily let go by the regulators, because at some point they may have to produce other things than cars for the country. In this case with metamaterials, I would argue that it's a similar thing, because they make parts for strategic goods. They may also be strategic in the eyes of the beholder. Over the past few days, the stock price of metamaterials preferred shares and common shares have skyrocketed by a huge portion. The stock has been trading between $1.50 and $2, and then things began to take off. The main reason seems to be a short squeeze. For the preferred shares, this is the new high, and certainly a very encouraging sight for the shareholders. It's currently hovering around $8, and over the past few days, we may argue that the stock definitely needs a pause to start regrouping and to consider whether they can go beyond the $8 level. This still remains to be seen, because Monday's trading session showed us that the stock is not really willing to go down yet, but they haven't decided to reorganize and to move onward. So I would say that patience would be key at this moment. For common shares, the starting point was relatively low, so the peaks are also very high compared to where it is right now, despite the recent takeoff. So the peaks were around $10, and it has been reached twice, back in 2014 and in 2021. Other than that, the price of metamaterials common shares has remained relatively low, including where it is now. So, compared to the preferred shares, the common shares are less hesitant at its current level to go higher, because there seems to be a clearer intention to go beyond where it is. So the conclusion based off the price action is, in the long term, metamaterials will tend to trade higher than where it is now, because of the external and the internal reasons, because of fundamentals and technical reasons. The online community and the media outlets suggests that this company is experiencing a short squeeze, which is probably accurate given that even though there might be other significant reasons as well, in my opinion, they're nowhere near as important as the short squeeze argument. Overall, the market remains challenging with the sluggish supply issues, the economy, the interest rates, but at the same time, maybe there might be increased demand for defense systems, which can potentially hedge somewhat the issues that metamaterials may be having with other sectors. So let's also take a look at the financials of the company. The company's revenue increased significantly over the past few quarters, from around $600K to $3.3 million, which is a very good sign that supports the idea that the company's business model is working and is also scalable. The operating expenses have also picked up, but not as much as the revenue increase. So this is also something that we have to take a closer look at, and so far is a good thing, because it means that they have the capacity and the willingness to always control their costs, to always make sure that they're not growing at the expense of their profitability. Because this is not a company that has like billions of VC fund money to just finance their growth. The cash reserves is mostly stable. It does have some fluctuations back in 2021 and 2022, but that's probably just, a question of, because they're still not having an operating net gain, they have to raise money with equity sales, that kind of things. The equity dilution has happened before, but it's going slowly at the current pace. From about 280 million shares in Q3 of 2021, it has reached above 300 million in Q2 of 2022. So the dilution has been occurring over time, but I'm not convinced that this is going to be a significant issue going onward. Now, the liabilities has also remained constant over time, which shows that they do try to keep a tab on how much debt they take on, keeping like the solvency risk at in my opinion, an acceptable level. Same goes for their cash outflows obligations. So overall, Mmat or Mmtlp, both the preferred and common stocks for metamaterials, is still having an operating loss, so eventually they will definitely have to show us that they can have a net gain. And frankly, the difference is not very high. So I think that over the next few quarters, we should be able to see something in that sense. Like, they may be able to start yielding net positive operating cash flows from like within a year from now, in my opinion. In terms of its clientele, I would say that metamaterials differs a little bit from many other stocks that we've covered so far, in the sense that it focuses on large clients. So they will probably have fewer client-customer relationships, but those relationships might be more lucrative individually. We should also point out the fact that with bigger clients, we can also expect more stable cash flows and more like upward momentum, in the sense that the demand of those big clients, if metamaterials can satisfy them, could be immense. Now, let's also take a look at the shareholder composition. There's currently about 15% of the institutionals. The rest of them are retail. This is a good sign for like on both ends. On one hand, it shows that there is enough like volatilities and active participation from the shareholders and the traders. And this is also going to be particularly useful if we're hoping that the stock is going to go through a short squeeze. The other thing is that with 15% of institutionals, this, to me, it shows that at least there's a significant amount of trust in like the company's long-term future. And if you want to buy in the stock, not to trade, not to like make quick gains with the short squeeze even, but to invest in the company to see it grow, then this is the kind of stuff that you want to see. the more institutionals there are, the more likely you're going to make a handsome return with investment instead of trading. Now, the other thing is the short size and short squeeze. Currently, there's about 6.6 million shares shorted, which kind of explains the sudden surge. Now, for metamaterials in particular, this can be very relevant and encouraging because its volume tends to be quite low. So for traders to actually exit their short positions, there might not be enough volume for them to get out at a low enough price. So this is going to push up the stock price even more. And in terms of the short squeeze, just a quick word. So the short squeeze, in my definition of what it is the action of people piling up, buying the stock up, forcing people with short positions for which they still have to incur financial fees every single day, that, well, you know what, they have to exit the position. And by doing so, they actually buy another bunch of the shares in the open market and they pay back to the brokers. So this also acts as another round of buying. So my opinion for metamaterials is this is a company with a lot of good news in a difficult market, and that's not very easy to find. It's very encouraging, and even though we still have to be careful with retracements, like if you want to buy the stock for the long term, then maybe it matters less. Like you can probably just DCA along the way. In this case, then leave a significant portion of the stocks for later to be bought. But if you want to profit from the short squeeze, I would say that maybe you just start the position by buying enough so that you don't fear of missing out. But apart from that, you know, I'm just saying, like, apart from that, still leave like a smaller portion of your allocation for later in case there is a retracement. Of course, if the stock just jumps from now onward, then yeah, you may have missed out the train. So this is why I said buy like enough so that you don't regret if the stock takes off. On the other hand, if the stock retraces from here, I would say that from, you know, the current level to maybe $3, you can DCA in over the next few days or even weeks. And my recommendation is to keep the exposure below 1%. The trader profile that should be considered is like the kind of traders who don't mind trading penny stocks, who believe that MMAT as a company has a future, and who also think that the current short squeeze is something legit, is something that is likely going to happen. But of course, always keep in mind that with this kind of scenario, there's always the possibility that it's never going to succeed. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.